Welcome to the Retirement Roadmap by SHP Financial, a podcast empowering today's retirees and pre-retirees to make well-informed financial decisions that will help you spend more time living and dreaming than worrying and wondering. Join me, Matthew Peck, along with my co-hosts, Derek Gregoire and Keith Ellis, as we share actionable financial strategies and insights, as well as interview top thought leaders in the world of finance, accounting, and estate planning. This is all aimed at preparing you for the retirement you've always dreamed of. Our high-quality holistic planning process has helped thousands of families retire and create what we like to call the ripple effect. The Retirement Roadmap is your guide to financial freedom. Are you ready to get started? Let's go.
Welcome, everyone, to another edition of the SHP's Retirement Roadmap podcast. I'll be your host today, Matthew Peck. And I certainly hope everyone is enjoying the spring and the nicer, drier weather that we've been having. And of course, the Celtics run right now, which I know I'm certainly enjoying as well. You know, nothing says Mother's Day like watching Game 7. I'm not sure if that's what Hallmark had in mind, but hey, it worked for me. And my wife was happy. So again, just want to wish everyone a happy spring as we go. Of course, I wish this podcast was going to be a little bit more happy when it comes to spring, but really wanted to dive into the debt ceiling because right now there is a massive game of chicken going on the federal level, and there certainly will be reverberations throughout the world, much less our economy, depending on how this game ends. Before I go any further, I certainly want to apologize if any of this podcast comes off as too political. It's very frustrating. There's a lot of frustration personally, and I'm sure all across the world, or at least again, certainly, I should say all across the world, because the U.S. dollar is kind of important, and the United States paying its debt is kind of important, paying our bills, as President Biden said, we're not a deadbeat nation. So I'll do my best to nail and to the wall both parties, of course. But really where it all comes from is the fact that this debt ceiling crisis, this debt ceiling negotiation, all of the issues that could potentially come from it are strictly self-inflicted. As you can see, the economy is dealing with enough as we speak, whether it's overcoming the inflation that we have dealt with over the past year and a half, the sort of all of the consequences from COVID, where high interest rates are right now, the potential that a recession is still lurking and still very strong based on many measures. And yet in the middle of that, we are having this hostage crisis, where the debt ceiling is being held hostage. And as I mentioned, it's truly self-inflicted, in which, again, that's why the frustration may boil over every once in a while. So first, let's talk about what the debt ceiling is. We are very unique in most Western democracies where we have to renew our ability, or Congress has to pass a law that allows for the Treasury and Janet Yellen to raise more, to issue more debt, to raise more cash in order to pay its bills. And this happens more frequently than we would like, but depending on if we have divided government or not, it has now become a political football for the debt ceiling to now become an issue, now become a negotiation tactic. Now, on the surface, when you zoom back out, it's very frustrating because, again, this is money that the federal government has already pledged to spend. So it's almost like you go to it's almost like the congressman or the U.S. congressman went to a restaurant, put something on, said like, yes, I'll buy that steak. That sounds great. But then the bill comes due. They say, nope, I'm not paying that. I'm not going to pay this. I'm not going to raise the money to pay this. So just the eyeball test of how it looks in regards to meeting our obligations is bad enough when it comes to our standing in the nation. But it is, as will be, and hopefully maybe less in the future, but probably not. It clearly is a very big political game to use this debt limit law that has to get passed to achieve certain goals. And certainly, again, the idea of reining in spending or finding some ways of good government, I have no problem with that whatsoever. But there is significant fallout that can happen. So that is what the debt ceiling is. It's just the ability for the federal government to raise more money to pay off current obligations, and that includes things like Treasury bills, which we'll talk about a little bit, but also includes things like Social Security benefits, veterans benefits, Medicare payments. So much of what the federal government does and everything it's involved with, if they're not able to pay their bills, everybody suffers almost on an individual basis, specifically when it comes to Social Security recipients. Now, that's also why most analysts think that it will get resolved, because it was resolved in 2011. It was resolved in 2013, and so most likely cooler heads will prevail, even if it's something that they just kick the can down the road and say, okay, hey, let's raise the debt ceiling until September and then do it all over again. So there has been a long history of this happening, as well as it eventually being resolved, which is again why most analysts think that nothing will come of it. But let's talk about what had happened in 2011, 2013, and why, as I mentioned, about some of the consequences of it, of why it's so important. 2011 was by far the strongest or the scariest of the moment, because that entailed a debt ceiling crisis, and it happened, and two things made it very volatile for the market, where the S&P 500 lost up to 20% during all of the negotiations. So buckle up if they're unable to at least modern times in 2023, if we are unable to come to some type of conclusion, the markets will get choppy as we go. But 2011 was very unique, or not necessarily unique, but it was unique in its own ways, in the sense that we were just emerging from the great financial crisis. 2008, 2009 was only 2 years in our rearview mirror, and so our economy was a little bit shaky to start. During that process, the reason why the 2011 debt ceiling crisis was so important was the fact that Standard & Poor's downgraded the United States debt. Downgraded our credit rating. Credit ratings are huge, because here is companies like S&P 500, Moody's, Fitch, etc. When they assign a credit rating to a government entity, a company, what they're doing is they're saying, okay, here's their credit worthiness, and when they move that credit worthiness up or down, it impacts borrowing costs. So when the United States was downgraded from AAA to AA or what have you, it raised the cost of servicing that debt. Suddenly, interest rates got a little bit higher because of the fact that they got downgraded. So think of it, again, it's like in your own situation, right? If you don't pay your bills, your credit score gets affected. And when your credit score gets affected, what you can get as a loan, if someone's willing to lend you money, gets affected. And now they say, yeah, sure, Evan. Again, I love picking on my producer. Sure, Evan, I'll lend you some money. But guess what? Because your credit score is less, well, I have to charge you more if I'm going to lend you money. And so that is by far one of the biggest consequences of this debt ceiling game of chicken, is that it did happen in 2011. And it could potentially happen again, where if they're unable to come to some type of an agreement, and our credit rating, or if there's any issue when it comes to our overall credit worthiness, it could dramatically increase the cost of borrowing. It could dramatically increase the amount of funds, of government money, that it needs to go towards servicing the debt. Because to digress a little bit on the debt and servicing the debt, I think we are all sort of nauseous when you hear the size of the United States debt, and you think about how much percentage of GDP and how big it is, and how it just sounds like such a scary amount about how we're constantly adding to the debt. Well, that is extremely important, but what's even more important is servicing the debt. Well, okay, if we have a lot of loans, but we can pay our bills, that's okay, because as long as we grow and continue to expand the tax base and continue to grow the economy, well, we can pay off that debt. Not a big deal. But if suddenly the cost of servicing that debt jumps because of bad politics, whatever you want to call it, well, then suddenly more of government money is going towards the paying off that debt. Well, now our interest rates are higher, the credit's that much more, so forth and so on. And what is the government going to do? Well, they may have to raise taxes to get that into line. Or now they can spend less to stimulate the economy during difficult economic times. By messing with the debt ceiling and not being able to pay our bills, and then our credit rating goes down, and then our cost of servicing the debt goes up. When we are talking about that big, massive debt that I mentioned in the United States, the ability, it constrains the governments in the future to do more for the economy during difficult times, and could potentially lead to tax raises to get our debt back under control. So not a good fallout, and that's what happened in 2011 when the United States were downgraded as a credit agency. And so that's one of the big fallouts that we're talking about too. Now, another area that could also get impacted that you may not initially think about, because of course, as I mentioned, Social Security and Social Security recipients is going to be, if we're unable to reach a deal, which, let me repeat, I don't believe, or most analysts do not believe will happen. They'll figure it out because it'll probably be last minute, but they'll certainly figure it out as we go. So Social Security recipients obviously will be affected because they're receiving government payments. That's a government debt. As I said, you got to pay your debts, right? But also, interestingly enough, money market funds. And money market funds are part of today's conversation because of their growing popularity. And I should also say because of the issues that banks were having. So a lot of clients had asked us, they said, okay, well, if they're unable to raise the debt ceiling, is that going to impact insurance companies? Is that going to impact banks? But one of the main areas that actually impacts the most are these money market funds, which have grown in popularity because of the yield that they're currently paying. I mean, some of the Fidelity funds that we have seen are paying anywhere from 3.5% to 4.5% on a money market cash, which is or a cash equivalent. Well, how does money market work? Well, these large companies that offer money markets, or what the money market is, are just short-term government debt, short-term what's called paper, commercial paper, really short-term little payments that must get made. That's the money market. And so another area that has seen a massive increase because, the reason why it's grown in popularity is not only that yield, but there's been some significant bank issues that I'm sure everyone is aware of. And so the money market saw a massive influx because, there's issues with banks. Money markets are now paying, let's say, on average 4% or whatever that may be. What a great place to park cash, especially because I know there's debt ceiling things going on. There's some volatility going on. But that's actually one area where it might also come under significant pressure. Because if there's a lot of redemptions there, I should say, but also more importantly, well, that yield and that interest that money market is based on is from these short-term paper from the United States government. And so money markets might get affected, which is and I should say too, the word that they use in the money market community is what's called break the buck. Because you assume, or the investor assumes that it is cash, and that if I put $1 into a money market, I could always take that $1 out. But if there's pressure on the money markets, where now, if an investor puts in $1 and they get less than $1 back, then money market accounts have now broken the buck, meaning that whatever was put in, someone actually lost money on a money market. When most people treat money markets as a stable cash equivalent and relatively, very conservative place to park money. So money markets. Banks, yes, will get affected, and insurance companies, but it's really this really short-term money market because. Back to as I said, about analysts thinking that the debt ceiling will eventually get resolved. But also the futures, but also like the price of assets, where short term, will they pay their June bill? Like some of these short-term paper, will the United States pay June or will it pay July? Well, those, the cost of those guys have been losing value because I don't know if they're going to be paid in June or July because of obviously the political gamesmanship that's happening. But the further on in the fall and even longer dated bonds haven't seen this type of activity because they say, okay, the politicians will eventually get their act together like they did in 2011 and 2013. But when asked specifically as to, okay, what does a debt ceiling mean to me personally? Well, if you're on Social Security, obviously that's the first one. And if you have a lot of money in the money market, you're also going to potentially be impacted, I should say. But let's also talk broader too. And I think this is the last thing I'll kind of end on before we talk about what does SHP do or what should you do, right? And as I said at the very beginning too, it's just the timing of it. If anyone remembered my most recent guide to the markets or Markets on the Move, Matt's Markets on the Move, a lot of M's there, I know. We talked about the fact that right now you have the bond market that was screaming recession, and then you have the stock market that said, no, everything is fine. What are you talking about? Now, granted, the bond market or bond traders are generally the doom and gloomers, and the stock market are generally the bulls, and they're very optimists. But both sides had plenty of ammunition to say, nope, a recession is imminent. Nope, we're going to get through this, and we're going to have some type of soft landing going on. And as I said during that podcast, I said, okay, here comes the wild card. Here comes the debt ceiling crisis. Well, this podcast is an extension of that. Okay, so this is the wild card, but those dynamics are still happening. There are still issues with the economy. We are still not on safe ground. We are still having this tug of war between, okay, will there or won't there be a recession? Well, if there is a debt ceiling crisis, if they are unable to come to a conclusion, and it does extend on, and not a couple days without it, but we're talking weeks and months, then that wild card that just entered that ring between the bulls and the bears and the stock market and the bond market, it's going to clearly and easily tip us towards recession. And it would be a recession, or certainly would be the consequences of which are so difficult to kind of fathom. Because I talk about Social Security and money markets, but we are talking about a recession. We are talking about the U.S. dollar internationally. We're already there's threats of the dollar. People say, the United States, because everyone uses the dollar, they have too much control. And now you see China and Russia and Saudi Arabia using different currencies to transact business, which was normally done in U.S. dollars. So that gets affected. Again, domestically, we talk about a recession. There would be a massive impact tilted in that direction. So that's sort of why most people think, again, that we're going to be able to come to some type of resolution. Because at the end of the day, it's the debt ceiling is like a hostage, but we're the hostage. The American public is the hostage, and the American prestige is the hostage, and the American economy is the hostage. So we're really going to hurt ourselves if we're not able to come some type of compromise and some type of agreement. And so, who knows? I don't personally think it will happen, but these are the questions that you have to prepare yourself, or at least understand as to what the consequences are. So last, you say, okay, what do I do about it? Well, if history rhymes, you ride it out. Even in 2011, which was a highly, much more volatile than the time in 2013, even in 2011, even though the markets dropped double digits during it, well, 6 months after the markets had recovered and had been actually surpassed where they were at that point in time. 2013, barely saw the market barely moved within that shorter time period. So historically speaking, you kind of, it's not an enjoyable ride because of that hostage scenario that I was painting, and because we are shooting ourselves in the foot, and because we are, threatening or dancing with a recession, which would be obviously bad for many, many people, much less jobs, much less the market. But in general, you ride it out because of the fact that, well, like most issues you do, of course, but at the end of the day, there's not much you can do about it. And eventually the leaders will come together and come up to some type of conclusion to this crisis. There'll be another crisis in the future. Don't get me wrong. That'll be the 2024 debt ceiling crisis. Not sure. Depends. To be determined. Can't wait. More podcasts talking about debt ceilings, right? But as long as your portfolio is well diversified, as long as you have a plan in place, then it's going to be a whole lot of noise, a whole lot of drama, and a whole lot of risk to the game that they are playing. Eventually the game will end, people will move on, and the economy will move on. So certainly pay attention to it as an American. I think it's important that we eventually come to some type of an agreement, of course. But when it comes to markets or your portfolio or making any dramatic change, we're in the grin and bear it type of phase right now. Thanks again for listening. I hope we found that very helpful, and stay tuned for our next episode.
Thanks for listening to the Retirement Roadmap podcast by SHP Financial. If you've enjoyed today's episode, be sure to hit the subscribe button so future episodes are automatically downloaded directly to your device. And if you've liked what you heard, please share the show. Create your own little ripples so we can help even more people with their retirement goals. If you want access to all past interviews, including notes, resources, and exclusive content from SHP Financial, visit shpfinancial.com/podcast. Thanks again for joining us on the Retirement Roadmap podcast. And for all the attorneys out there, disclaimers and disclosures, I'm just going to put on my super serious voice and add our own. No statements made during the Retirement Roadmap podcast shall constitute tax, legal, or accounting advice. You should consult your own legal or tax professional on any such matters. Information presented is for educational purposes only and does not intend to make an offer or solicitation for the sale or purchase of any specific securities, investments, or investment strategies. Investments involve risk, and unless otherwise stated, are not guaranteed. Our investment advisory services are offered through SHP Wealth Management LLC, an SEC-registered investment advisor. Insurance sales are offered through SHP Financial LLC. Our advisors and insurance reps may offer clients advice and/or products from each entity. No client is under any obligation to purchase any insurance product.